Lately, you've probably seen the headlines screaming about the India EU free trade agreement. Most people are talking about one thing: will my favorite French wine get cheaper, or will German cars finally be affordable? But here's the truth: that's just the tip of the iceberg. If you're an investor, the real money is being made deep underwater in the sectors nobody is looking at. Today, we are decoding the silent alpha of this deal, the structural winners, hidden risks, and why this is a 10-year investment play. First, let's talk about the why. Why is Europe so desperate for this deal? Think of this FTA as Europe's American insurance policy. With US trade policies becoming super unpredictable, hitting exporters with massive 50% tariff burdens, Europe needs a safe harbor. They are securing a supply chain outside of Washington's pressure and hedging against China's supply chain risks. For us, this creates a safe zone for capital. When the US imposes reciprocal tariffs, India gets zero duty access to Europe. That is a massive competitive edge for our companies. Now look at this iceberg. Most people are focused on the goods, the cars, the wine, but as we say at Mindful Rupee, cars make noise, but services make cash. This is the real cash cow. We are getting direct access to 144 service subsectors. For professionals, there is a guaranteed 9 to 12 months stay back to find work, and ICT visas now come with family rights. The structural winners here focus on IT, engineering design, and pharma research. These sectors aren't just growing, they are being integrated into the European economy. But here is the gotcha. You can't just import parts from China, put a made in India sticker on them, and ship them to Paris duty free. This deal has a strict rules of origin filter. To get that 0% duty, you need 35 to 40% local value addition. This kills the China via India loophole. It's bad for pure assemblers, but it is a gold mine for vertical integrators. If you're looking for stocks, names like Bharat Forge, KPR Mill are the ones that pass this filter because they manufacture end to end in India. Let's talk about a risk that's not on most balance sheets yet: ESG. European access isn't free, it is compliance linked. Meet CBAM, the Carbon Border Adjustment Mechanism. It's basically a carbon wall. If a company uses dirty energy, this tax will erase all their FTA benefits. By 2027, if a company doesn't pass a sustainability audit, there is no deal. As investors, we have to start auditing the ESG scores of our holdings as strictly as their P&L. So, who are the big winners? In textiles, we see a $4 to $5 billion growth potential. Gokaldas Exports and KPR Mill are the volume plays, while Wellspun is the margin play in high-end home textiles. In auto and engineering, component duties are dropping to 0%. Watch Tata Motors, specifically for JLR, and Motherson Sumi for their China plus one sourcing. And don't sleep on seafood. Removing a 26% duty means direct bottom line expansion. Stocks like Apex Frozen Foods and Avanti Feeds could see earnings jump almost immediately as their export potential grows from $1 billion to $1.8 billion. The losers and the 10-year plan. Every deal has losers. Sula Vineyard faces a tough road ahead as wine duties could drop from 150% to 40%. Even PSUs like BHEL or Ercon might see margins compressed as EU giants enter the government tender space. Finally, remember the timeline. The market usually overestimates the short term but underestimates the long term. 2026 is when the first wave hits. By 2032, we are looking at $60 to $80 billion impact. Run your watch list through our Investors Alpha checklist. vertical integration, ESG score, quota headroom. This isn't just a trade deal, it's India being written into the global economic future. Stay mindful, stay invested.